All right, let's get right into a really fascinating story coming out of Alibaba's latest earnings report. Now, on the surface, the numbers looked, well, like a miss. But the market's reaction was a huge stock surge. So what's going on here? We're going to unpack exactly why Wall Street got so excited.
And that really brings us to the core puzzle of this whole thing. It's a question that kind of seems to fly in the face of how markets are supposed to work, right? How on earth does missing your sales target lead to your stock having one of its best days?
So let's just look at the raw data for a second. The folks on Wall Street, the analysts, they were expecting revenue of almost 253 billion yuan. What Alibaba actually brought in was closer to 248 billion. That's a clear miss. Logically, the stock should have gone down. Instead, it shot up an incredible 12.9%. The math just doesn't seem to add up here.
And if you look at the headline revenue growth year over year, it was just 2%. Now, for a massive tech company like Alibaba, a number like 2%, that should be a huge red flag, not something to cheer about.
But like with any huge company, that one little headline number is hiding a way more interesting story. It's almost like there are two different Alibabas operating at the same time right now. And investors, well, they've clearly decided which one they're betting on.
So let's start with story number one. The company's main business, its bread and butter, e-commerce. This is the part of the company that's stuck in a really expensive, very present-day fight. And that fight is all about something called instant commerce. Just think about getting stuff you buy on Taobao, their main shopping site, delivered to you in an hour or less. We all love that kind of service, but for a company, it is incredibly expensive to pull off. It puts Alibaba in a head-to-head cash-burning war for delivery speed against some really tough rivals like JD.com and Meituan. And this slide, wow, this just lays out the two different stories perfectly. Look at the left side, the e-commerce business. Okay, revenue grew a decent 10%, but look at its profits. They fell by 21%. Now look to the right, at the cloud business. Revenue growth there is more than double, at 26%, and its profits grew right along with it. These are two totally different trajectories. And that 21% drop in profit? Well, that's the bill for that instant commerce war we just talked about. Alibaba is choosing to sacrifice its profit right now to defend its turf. And that's exactly the kind of thing that usually makes investors really, really nervous. But, and this is a huge but, here's the pivot in the story. While that expensive commerce war is going on, another part of Alibaba is turning into an absolute powerhouse, a real growth engine, and it's painting a very different picture of the future. You see, it's not just that the cloud division is growing, it's that the growth is actually speeding up. It jumped from 18% last quarter all the way to 26% this quarter. That is some serious momentum, and that's the kind of thing that gets investors to sit up and pay close attention. So the real question is, what's behind this?
And the answer is artificial intelligence. Buried inside that impressive 26% cloud growth is this absolute monster of a number. AI-related services are growing at a triple-digit rate. Yeah, you heard that right. We're talking well over 100% growth from last year. This is the secret engine that everyone got so excited about.
And what's really crucial here is that this isn't some flash in the pan. This is the eighth consecutive quarter of this massive triple-digit AI growth. This isn't a blip on the radar. This is a powerful, sustained trend. And hey, you don't just have to take my word for it. The company's CEO, Eddie Wu, he put it right at the front and center of his comments. He directly pointed to robust AI demand as the reason for the cloud division's amazing performance. He basically confirmed for the whole market that this is where the company's focus is now. So now we can finally put all the pieces together and solve that paradox we started with. The stock jumped because investors looked right past the costly problems of today and placed a really firm bet on a much more exciting and profitable future. The company has made its strategy super simple, boiling it down to just two main pillars. On one side, you have consumption. That's the whole e-commerce business. And on the other side, you have what they see as the future, AI and the cloud. This kind of clarity really helps investors see where the company is headed. When you get right down to it, investors are seeing a company that's making all the right moves for the long term. It's cashing in on a super high-growth, profitable AI business, while at the same time showing it's tough enough to take some short-term profit hits in its main business to make sure it stays dominant for years to come. And that's really the final resolution here. The market is making a calculated bet.
They're saying, yeah, the e-commerce wars are expensive, no doubt, but the incredible, sustained, triple-digit growth coming from this new AI engine, they believe it's going to be so much bigger that it completely overshadows the temporary costs of that battle. It's a classic story of focusing on the future, not the past.
Which kind of leaves us with this one big thought. Alibaba has clearly hitched its wagon to the AI racket. The question now is whether the incredible power of this new engine can generate enough thrust to pull the whole company into a new orbit, one that's far away from the gravity of its old, costly wars. I guess only time will tell.